Hi Vinay, thank you for stopping by and joining us on the show this afternoon. The stock of the moment seems to be Crompton Greaves. A disastrous set of numbers, big losses in the power systems business. How would you approach a stock like that now?
Crompton Greaves has been facing a lot of headwinds on and off. Their European business went into a lot of stress. Again, the power sector on the domestic side, the market is shifting significantly towards higher voltage and higher wattage the transmission and distribution systems and so on. And the international MNC players obviously have a product advantage in that particular sense. So Crompton continues to face pressure, and the numbers which have come in, we have to go into the details and check out what have been the exact reasons why they've been so poor. But overall, the scenario looks quite challenged for a company like Crompton.
Vinay, hi, good afternoon. What about something like a Lupin, where again we have seen, big cracks. Even yesterday and today also the stock is falling more.
So if you look at the overall pharma space, there are a few things which are happening in US, and Lupin is suffering from some of those. Now, one is that there is a distribution system where there is a lot of acquisitions happening. So the pricing power is moving significantly to the large distributors, which is causing pressure on the generic companies like Lupin in the US market. So there is a clear pricing pressure which Lupin is facing. Plus, there is a 483 that is there on the Goa facility of Lupin. Now, a couple of these things are adding up to a poor set of numbers and a challenging environment. In addition, the Gavin acquisition, which they have done for almost $82 million, appears to be quite expensive, given almost just $96 million of revenue that company has. Though it's the company is stating that the product pipeline of that company is very, very good. There are almost 66 products in the pipeline. Plus, there is a possibility of another 60-odd products which could come into the pipeline over the next 2 to 3 to 4 years. So, market is making a sense that currently the company has hugely overpaid for this acquisition, and that's another reason which is having a pressure on the price.
Okay. The other stock that I wanted to ask you about, and we should pull up that intraday chart, is ICICI Bank. Not just today, the stock is down about 4%, but this year the stock has, lost almost 15% of its value. Now there are increasing fears about some of these accounts like JP Associates defaulting, etc. What is your own view of how to approach a stock like ICICI?
You see, overall, we do prefer the private banking space vis-a-vis the public sector banks, given the NPA position in the system. But having said that, ICICI Bank is known to have higher component of stress tested as compared to some of the more blue-blooded names like HDFC Bank and so on. So, along with the increased pressure on the NPAs and some of the accounts which you have mentioned are appearing more and more stressed out, that is one reason why the ICICI Bank is facing some pressure on the price. In addition, the overall credit growth numbers are not too inspiring for the entire banking sector, and that's the second reason why you are finding that some of the banks are facing pressure both in terms of the top line as well as in terms of the bottom line.
Did you take a look at Axis Bank's numbers, Vinay, prima facie? What's your call here?
No, we haven't really taken a look at those numbers. They've just come in.
Okay, so let's talk about the IT space. We've seen Wipro also react negatively to earnings today, down about 4%. We saw that big surge in Infosys. After that, it's seen some profit booking. TCS has been a bit weak. How are you reading the IT sector numbers?
So let's look at what's broadly happening in the IT space. In the standard application development and maintenance space, in which the Indian companies have been very, very strong, you are facing clearly some pressures. There is no ability to increase prices. The competitive intensity is very, very high. While at the same time, large number of workers which are employed in India, you have to give them year-on-year price hike, the salary hikes and so on and so forth. So the market is shifting to SMAC and the digital side, where the opportunities are coming. Now, these opportunities lead to one need for a higher degree of very differentiated skill sets. And that's what Infosys and TCS appear to be focusing upon. There is a clear focus to train very large number of employees in these particular segments. Second, the ticket sizes tend to become smaller, and the duration of the projects are much, much smaller. So overall, if you see, the market is shifting, and some of these companies, especially TCS, Infosys, appear to be very focused to capture onto the new segments which are appearing. In the interim, there would be pressures which you find being reflected in the numbers. Let's say in case of TCS, Infosys is able to handle them better under the new leadership of Mr. Sikka. And you will have to observe them quarter to quarter in terms of their ability to handle the headwinds and so on. At this point, Infosys appears to be in the best position to handle the headwinds and to take the company and the business to a new level.
Okay, that's a fair point. We've been talking about a lot of the weakness in many companies, etc. But I guess for a retail investor, the best time to buy any good quality company is during times of adversity. So what are you advising retail investors to do now? What are the stocks that you should be looking at despite the slow momentum in the market one can accumulate?
So you're absolutely right, Sonia. We are very bottoms-up stock pickers in that sense, and pretty sector agnostic and market cap agnostic. And any stress in markets or any sign of poor results which leads to market cracking a bit provides you with very good opportunity to do bottoms-up stock picking. SRF is one idea which we like particularly. The stock has done well for itself in terms of the accretion in the market price. But that's an interesting bet. If you look at the business model of SRF, it's into tire cord business, which is considered a pretty sunset industry. But if you take a deeper look at the numbers, almost 2,000 crores of revenues or 1,900 crores of revenues, which have been more or less stagnant for last 4-5 years. But the EBIT has gone up from almost 105 crores to about 190 odd crores. So that's a pretty good cash flow business that is coming out. The plastic film business, the BOPET business, has had a very bad time. It's a pretty cyclical industry. We are at the bottom of the cycle, that is our sense, and in the next 1 year or so, that particular segment should start throwing good numbers. But the reason why we like SRF the most is because of the specialty chemical business. Company has a very strong presence in the fluorine chemistry space, where it's the market leader both in terms of chemistry as well as in terms of its ability to convert that chemistry into products. So it's doing work for some of the global majors in terms of producing molecules. This is a very high margin business, almost 30-35% kind of an EBITDA margin could be generated. The business is doing very well. There is very strong growth that is coming in. So our sense is over the next 4-5 years, the company's top line as well as bottom line contributions will significantly come from this particular business, and the overall profile of the business will change. So you will have a very high ROC business in specialty chemical space, and that's why one reason why we like this stock so much. And our belief is that the stock could see significant upside even from the current levels.
Okay, one last question from my end then. What about the two-wheeler numbers so far? We had Bajaj Auto, of course, yesterday. Today was TVS Motor. Anything that stands out for you? TVS, of course, you may not have had too much time to look at, but Bajaj numbers?
So in terms of Bajaj, number one, there is a certain degree of disappointment. If you see the volume growth, that's just been 2%. Now, our sense is there are 2-3 factors which are playing out. One, in terms of exports, their mix has changed. And obviously, they are facing some degree of pressure which is coming out there. Second, what is happening is in terms of the sports bike segment, where the Pulsar was a dominant player, they are facing significant pressure from the other market leader, which is the Bullet bike. Now, on the compact bike side, Hero continues to remain the dominant player. So overall, you're finding that the company does not appear to be able to do much in terms of increase in volume. Pricing pressures and pricing scenario remains the same. In addition, our sense is that the market is shifting significantly towards scooters, where he is not present. So overall, if you look at the scenario, that looks pretty challenging for Bajaj. And almost at 18 times current year's earning, the stock is not very, very cheap in that sense. So overall, a very average kind of scenario for Bajaj as well as for the motorcycle makers.
Okay. You spoke about SRF. Any other ideas from the mid-cap space that catch your eye that are good long-term buys?
So another idea that we really like is in the sub-1,000 crore market cap segment, which is the Kikuna Limited. So it's a company which is into quartz and granite marble stones. They are significant exporters to US and to Western Europe. And what is so special about this company is that earlier they were only into the granite space. Now we all know that granite comes out of the earth, which means you are significantly dependent upon geologists to ability to find the mine, and then the quality of the stone that comes out in the mine is another imponderable. You really can't get it. And at times you will dig for a few meters and get a very good quality stone, which changes as you go deeper. But subsequently, the company has got into the manufacturing of quartz slabs. Now, these slabs could easily replace the granite tiles and granite slabs. This product is priced almost 2 to 3 times the high-end granite and marbles. And the dominant market for this product is in the United States. Now, just to give you a sense, the end product, the finished product, including the fixing cost, this is called as tabletop market, cost almost $120, $130 per square meter. Company sells it to, on a B2B basis, at less than $10. Now, that's a significant opportunity. It's a very high return on capital business. It's a business which is growing very, very fast for Kikuna. And again, as the component of granite and marble sales comes down in the overall, the top line as well as on the bottom line, and the component of quartz sales goes up, the company's bottom line profile, the capital efficiency ratios, and the moat around that business make it a very, very attractive bet for us.
Okay, Vinay, thanks a lot for your time. Would you like to make a disclosure?
So it is safe to assume that some of the stocks that we have, that I have discussed, have financial interest from my end.